Digital Assets for Investors. Chapter 14, Security and Custody. Section 1, Wallet Types. Before comparing wallet types, it helps to fix one common misunderstanding. A wallet does not literally hold your coins the way a physical wallet holds cash. The assets remain recorded on the blockchain, and the wallet's real job is to manage the credentials that let you authorize movement of those assets. In practice, the most important credential is the private key. That is why choosing a wallet is really choosing how your private keys will be stored, protected, and accessed. If you remember that point, the differences between hot, cold, and custodial wallets become much easier to understand. Wallets are usually grouped into three broad categories based on where the keys are kept and who controls them. Hot wallets keep your keys on internet-connected devices, which makes them fast and convenient but more exposed. Cold wallets keep keys offline or isolated, which improves protection but adds extra steps when you want to use the assets. Custodial wallets are different because a third party, such as an exchange, controls the keys for you. These categories are not about one wallet being universally best. They describe different trade-offs between convenience, security, and control. For investors, the right choice depends on what the funds are for and what kind of risk you are willing to accept. Hot wallets are the most familiar option because they are built for speed. A mobile app, browser extension, or desktop wallet lets you send, receive, and check balances quickly, which makes hot wallets practical for routine payments and regular transfers. The trade-off is that these wallets live on devices that are connected to the internet, so they are more exposed to phishing, malware, and device compromise. That does not make them bad tools. It means they are best used for amounts you expect to access often. Many investors treat a hot wallet the way they would treat spending cash rather than long-term savings. Convenience is the strength of a hot wallet, but limiting the balance is usually the discipline that makes that convenience safer. Cold wallets aim to reduce online risk by keeping private keys offline or separated from internet-connected devices. Common examples include hardware wallets and, more historically, paper-based storage methods. Because the keys are not sitting on an online phone or computer, cold storage is often used for larger balances and long-term holdings. The cost of that added protection is convenience. Sending funds usually takes more steps, more verification, and more patience than using a hot wallet. The main risks also change because you worry less about remote theft and more about physical loss, damage, poor backups, or setup mistakes. Cold storage is strongest when it is treated as a savings tool rather than an everyday transaction tool. Custodial wallets feel simple because they work a lot like online financial accounts. You log in with a username, password, and maybe two-factor authentication, but the provider is the one actually holding the private keys. That means the platform signs transactions on your behalf and controls whether withdrawals are processed smoothly. For beginners, this can feel easier than self-custody, especially when the main goal is trading or using services inside one platform. But the convenience comes with a different kind of risk. You are depending on the custodian's systems, controls, and financial stability. Even if your own login is secure, you can still be affected by exchange hacks, withdrawal freezes, or business failure. So custodial access may be familiar, but it is not the same as direct ownership of the keys. Underneath all wallet types, the same basic pieces are doing the work. The private key is the secret that authorizes transactions, the public address is what you share to receive funds, and the seed phrase is the backup that can recreate the wallet and its keys. This is why seed phrases must be treated with extreme care. In many wallets, anyone who gets that phrase can restore the wallet elsewhere and control the assets. People sometimes confuse a seed phrase with an account password, but they are not the same thing. A password may protect access to an app on one device, while a seed phrase is usually the master recovery path to the funds themselves. Once you see those roles clearly, wallet security becomes much more logical. A simple way to remember the differences is to ask two questions. First, who holds the keys? You or a third party? Second, are those keys online or offline? A hot wallet means you hold the keys, but they are on an internet-connected device. A cold wallet means you still hold the keys, but they are kept offline. A custodial wallet means someone else holds the keys, regardless of how polished or convenient the app may look. From those two questions, most of the important risk and control differences follow naturally. If you can answer them for any wallet product, you already understand far more than many new investors do. In practice, many investors do best by using more than one wallet type. A small amount in a hot wallet can cover everyday spending or quick transfers without exposing your full holdings. Most long-term savings can sit in cold storage, where convenience matters less and protection matters more. If you trade actively, you might also keep a limited amount on a custodial platform for that specific purpose, rather than leaving everything there. This kind of separation by job helps reduce the damage from any single mistake or failure. Just as important, the seed phrase or recovery backup should be stored securely and separately from the device itself. Good wallet use is often less about finding one perfect tool and more about building a sensible system. Many wallet problems come from using the wrong tool for the wrong purpose. Keeping long-term savings in custodial storage may feel easy, but it leaves you exposed to third-party failure. Holding large balances in a hot wallet creates unnecessary online risk when cold storage would be more appropriate. Another common mistake is confusing exchange access with actual ownership of private keys, which can create a false sense of control. Physical mistakes matter too, such as storing a hardware wallet and its seed phrase together, which creates a single point of failure if they are stolen or damaged. Even the purchase process matters, because buying a hardware wallet from an unofficial reseller can introduce tampering risk. Most of these errors are avoidable once you think in terms of purpose, key control, and backup design. At the end of this section, the key idea is that wallet choice is really a risk management decision. Hot wallets are useful when speed and convenience matter, cold wallets are stronger for long-term protection, and custodial wallets may make sense only when the service or ease of use is worth trusting a third party. No option removes risk completely. Each one changes where the risk sits. The right choice depends on how often you need access, how much value you are protecting, and how comfortable you are relying on someone else. For every wallet decision, the most important question remains the same. Who controls the private keys? That single question brings clarity to almost every custody choice you will face. Section 2. Private keys. Private keys matter because they are the real foundation of control in cryptocurrency. A private key is not just a technical detail in the background. It is the secret number that allows transactions to be authorized. In a self-custody setup, whoever has that key can control the assets linked to it. That is why loss and theft are such serious risks. If the key is stolen, an attacker may be able to move the funds, and if the key is lost without a backup, access may be gone permanently. This is very different from systems where ownership depends mainly on identity checks or account recovery. In crypto, the private key is the core proof of control. It helps to stop thinking of a private key as if it were just a bank password. With a bank account, there is usually a central institution that can verify your identity, reset credentials, and restore access after a mistake. In cryptocurrency, there is generally no such reset authority for self-custodied funds. If you lose the private key, the network does not know that you are the rightful owner in the ordinary sense. It only recognizes valid cryptographic authorization. If someone else gets the key first, the network may accept their transaction just as readily. That is why private key security carries much more personal responsibility than normal account security. The absence of a recovery safety net is one of the biggest mindset shifts for new investors. When you send crypto, the private key does not get broadcast to the network. Instead, the wallet uses that key to create a digital signature on the transaction details, such as the destination and amount. The network then checks whether that signature matches the public information associated with the wallet. If it does, the transaction is accepted as authorized. This is an elegant part of the system, because the secret itself stays hidden while still proving control. You can think of the private key as a signing tool, not a file that gets handed over each time. Understanding that process helps explain why protecting the key is so important, even though the key itself is not visible on the blockchain. To make sense of wallet security, it helps to separate three related concepts: the private key, the public key, and the address. The private key is the secret and must never be shared. From that secret, public information is derived, eventually leading to a public address that other people can safely use to send funds to you. So the direction of dependence flows one way: private key to public address. People can know your address without gaining control of your assets. Control stays with the secret key, while receiving can happen through the public address. That distinction is one of the basic building blocks of how crypto ownership works. A common misconception is that private keys are somehow stored on the blockchain. They are not. The blockchain records transactions, balances, and public data, but your private key exists only in the environment where it is generated, stored, or backed up. That might be a phone, a computer, a hardware wallet, or a recovery medium such as a written seed phrase. This matters because security depends on the places where the key or its recovery path actually lives. If those places are poorly protected, the blockchain itself cannot save you. In other words, the network records ownership rules, but your custody setup determines whether you can safely use them. People often mix up private keys, passwords, and seed phrases, but they play very different roles. The private key is what directly controls the funds. A wallet password usually protects access to an app, file, or device, which is useful, but is not the same thing as the cryptographic secret that authorizes spending. The seed phrase is different again, because it can usually recreate the wallet and regenerate the private keys. That means a stolen seed phrase can be just as dangerous as a stolen private key, and in many cases even more useful to an attacker. Confusing these terms can lead people to protect the wrong thing, or underestimate the risk of exposing a backup. Clear vocabulary leads to better security decisions. Many modern wallets are HD wallets, which stands for Hierarchical Deterministic Wallets. The main advantage is that one seed phrase can generate many private keys and many addresses in an organized way. That means you do not have to back up each key separately. As long as the seed phrase is recorded correctly, the wallet can be restored and the whole structure can be rebuilt. HD wallets also make it easier to generate fresh addresses over time, which can improve privacy by reducing address reuse. For investors, the practical lesson is simple. One good backup can protect a broad set of wallet activity. But that also means the seed phrase becomes extremely important, because it is the root of the whole system. Consider a simple Bitcoin example. Suppose you withdraw Bitcoin from an exchange into a wallet on your phone. At that point, the wallet already holds the private key needed to authorize future spending from that wallet. Later, when you send part of that Bitcoin to a friend, you enter the amount and destination, and the wallet signs the transaction on the device before broadcasting it. The network verifies that signature and accepts the payment if it is valid. The key point is that the private key is doing the authorizing work behind the scenes. You are choosing what to send, but the wallet is using the key to prove that the transaction is legitimate. Because the private key is the core secret, it also becomes the main point of failure. If there is no proper backup, a lost phone, damaged device, or accidental deletion can mean permanent loss of access. Malware can search for keys or seed phrases, and fake apps can trick users into entering sensitive information directly. Even storage habits that seem convenient, such as saving recovery data in cloud notes or screenshots, can increase exposure significantly. In many real-world losses, the problem is not advanced cryptanalysis. It is poor handling, bad backups, phishing, or malicious software. Strong security often comes down to reducing those ordinary but dangerous mistakes. Safe handling starts with using reputable wallet software or hardware from trustworthy sources. As soon as a wallet is created, the backup should be recorded carefully rather than postponed for later. That backup should be stored offline and in a secure place, not left in email, screenshots, or cloud folders where it could be exposed. It is also important never to paste a private key or seed phrase into a website, even if the site claims to be for support, recovery, or verification. Legitimate services do not need your private key to help you. These habits may sound simple, but they prevent many of the most common and costly failures. In crypto, routine discipline often matters more than technical sophistication. Recovery depends entirely on the quality of the backup. If the seed phrase is written down incorrectly, stored poorly, or never tested, it may fail at the exact moment it is needed most. That is why each word must be recorded exactly in the correct order and kept somewhere secure. A practice restore can reveal problems early, before meaningful funds are at stake. Even a single missing or misspelled word can block recovery. This is not just a convenience feature sitting in the background. It is the actual path back to your assets if the original device is lost. Investors who understand that tend to take backup quality much more seriously. The main takeaway from this section is straightforward. A private key is not merely a password for logging in. It is the cryptographic secret that gives real control over cryptocurrency. It should be protected like a high-value secret, backed up carefully, and treated as compromised if it is ever exposed. Self-custody can provide strong control, but that control comes with responsibility. There is no benefit in owning the keys if they are not recoverable, and no safety in having a backup if it is easy for someone else to steal. Secure custody means balancing protection with recoverability. That balance is at the heart of responsible crypto ownership. Section 3. Cold storage. Cold storage is best understood as a way of keeping private keys off internet-connected devices. Instead of leaving the keys on a phone, laptop, browser extension, or Exchange account, cold storage keeps them offline so they are less exposed to remote attacks. That makes it especially useful for long-term holdings that do not need to move often. The main benefit is reduced exposure to online threats such as malware, phishing-driven wallet compromise, or exchange-related breaches. Cold storage does not make funds invincible, but it changes the threat model in an important way. Rather than defending keys on active online systems, you are isolating them from many of those systems altogether. The improvement in online protection comes with trade-offs. Cold storage is slower to access, slower to transact with, and usually requires more careful setup than a simple phone wallet. That means risk does not disappear, it shifts. You reduce remote theft risk, but you increase the importance of physical security, backup quality, address verification, and careful process. A rushed cold storage setup can still fail badly if the seed phrase is written incorrectly or the wrong address is used. So the real lesson is that cold storage is not a magic object. It is a security method that works best when paired with deliberate habits. There are several main forms of cold storage, and each comes with different strengths and weaknesses. Hardware wallets are the most common practical option for individual investors because they combine offline key protection with relatively manageable usability. Paper wallets are simpler in theory, but they are fragile and easy to handle badly. Air-gapped computers can be very secure because they never connect to the internet, but they require more technical discipline and introduce more operational complexity. All three methods aim to keep keys offline. The difference is in how easy they are to use correctly and how much room they leave for mistakes. For many investors, a hardware wallet is the most practical form of cold storage. The device is built to keep private keys inside it and to sign transactions internally, so the key does not have to be copied onto your computer. In a typical workflow, the computer prepares a transaction, the hardware wallet signs it, and the signed transaction is then sent out to the network. That separation helps protect the key even if the computer is less trusted than the hardware device. But the device itself is not the full backup plan. The real recovery path is the seed phrase created during setup, which is why that phrase must be protected as carefully as the device, and often even more carefully. Paper wallets sound appealing because the basic idea is simple: keep the key offline on paper. In practice, though, they are fragile and easy to mishandle. Paper can burn, tear, fade, or be damaged by water, and even the process of printing can create risks if the printer retains copies or if the generation method is not truly secure. There is also an important usage problem. Once you import the private key into an online wallet to spend from it, the setup is no longer really cold. That is why sweeping the funds into a modern wallet is generally safer than trying to reuse the same paper wallet repeatedly. Simplicity on paper does not always mean safety in real life. Air-gapped computers take the offline idea even further. In this setup, a computer used for signing transactions is kept permanently disconnected from the internet, and transaction files are moved back and forth using removable media. From a security perspective, that can be powerful because the signing environment stays isolated. But the extra steps create more room for user error, operational confusion, and accidental mistakes. This is not usually the best starting point for beginners. It is better suited to advanced users who understand both the technical process and the discipline required to maintain that isolation over time. Strong security can come from complexity, but complexity can also be its own source of risk. A careful cold storage workflow starts with generating keys in an offline or isolated environment. The seed phrase should then be recorded offline as well, by hand or through another secure method that does not create unnecessary digital copies. The device and the backup should be stored separately so that one theft, fire, or accident does not wipe out both. Funds should only be signed for movement when needed, and then the setup should be secured again. This kind of process sounds cautious because it is. Cold storage works best when each step is intentional, boring, and repeatable. Good security often looks less like cleverness and more like disciplined routine. Cold storage makes the most sense when the assets are valuable enough and inactive enough to justify the extra effort. If you are making frequent payments or regular trades, the delay and friction of cold storage may be impractical. But for larger balances that you plan to hold for months or years, that same friction can be a feature rather than a flaw. It creates distance from impulsive actions and reduces everyday online exposure. The choice is really about matching storage method to use case. Small, active balances may belong in hot wallets, while larger, less active holdings often fit cold storage much better. The amount involved and the need for quick access should guide the decision. A strong hardware wallet setup begins before the device is even turned on. Buying directly from the manufacturer or an authorized source reduces the risk of tampering, and checking packaging and setup prompts carefully adds another layer of protection. During setup, the recovery seed should be written by hand and kept fully offline, not photographed or stored digitally. The hardware wallet and seed phrase should then be stored in different secure locations so that one event does not compromise both. For monitoring, you can often use public addresses to check balances without exposing private information online. A small test transaction from time to time can also build confidence that the setup works as intended. The strength of the system comes from the combination of offline signing, trustworthy sourcing, and careful backup design. Cold storage mistakes are often surprisingly ordinary. Buying a device from an unknown reseller can introduce tampering risk before you even begin. Storing the seed phrase digitally may feel convenient, but it defeats much of the purpose of keeping keys offline. Relying on the device alone is another mistake, because if the device is lost or damaged without a usable seed backup, access may be gone. Reusing old addresses or handling paper-based tools carelessly can also create privacy or security problems. Many failures happen because setup is rushed or because backups are not protected against theft, fire, or flood. Cold storage rewards patience, verification, and a willingness to treat the process seriously. Section 4. Exchange risks. Centralized exchanges offer convenience, but that convenience changes the nature of ownership. When you deposit funds onto an exchange, you usually give up direct control of the private keys tied to those assets. The exchange controls the on-chain wallets, while your account balance becomes a claim within the platform's internal records. That distinction matters because your ability to withdraw now depends on the exchange's systems, rules, and willingness to honor withdrawals. In self-custody, you authorize movement directly. On an exchange, the platform stands between you and the blockchain. The user experience may feel smooth, but the custody reality is fundamentally different. Exchanges introduce risks that do not appear in the same way when you hold your own keys. Because customer assets are often pooled, exchanges become attractive targets for attackers who know a single breach may affect many users at once. Many platforms also maintain hot wallet infrastructure for operational reasons, which increases online exposure. Beyond technical threats, users are also exposed to internal failures, such as poor controls, outages, fraud, or weak risk management. This is why counterparty risk becomes central in custodial arrangements. You are not only trusting software, you are trusting a business, its leadership, and its operational discipline. That is a very different security model from self-custody. Most of what happens on an exchange does not happen directly on the blockchain. When you deposit assets, the exchange credits your account internally, and your funds are usually mixed into pooled wallets rather than sitting in a separate wallet you control. Trades between customers often just update internal balances inside the exchange's ledger. The blockchain may only be involved again when someone deposits or withdraws. This structure makes trading faster and cheaper, but it also means users must trust the platform's records and custody practices. A withdrawal request is not the same thing as an immediate on-chain transfer. The actual transfer only happens when the exchange processes and sends it. One of the most important lessons in exchange risk is that a visible balance is not the same thing as immediate control. Your account may show assets clearly on screen, but if withdrawals are paused, limited, or frozen, You cannot force those funds to move. In that moment, the balance behaves more like a claim against the platform than property you can directly access. Withdrawal interruptions can happen during investigations, technical incidents, liquidity stress, or broader business problems. Sometimes they are short, and sometimes they last far longer than users expect. If the situation becomes severe, recovery may depend on legal proceedings rather than ordinary account access. That is why custody risk cannot be judged only by what the app says your balance is. It helps to separate exchange-level risks from user-level risks because they require different thinking. Exchange-level risks include hacks, insolvency, frozen withdrawals, weak internal controls, fraud, or liquidity stress inside the platform itself. User-level risks are things like phishing, weak passwords, social engineering, or account takeover targeting your specific login. Both are serious, but they are not interchangeable. A well-protected account cannot save you from exchange insolvency, and a financially strong exchange cannot always save you from handing credentials to a scammer. Platform protections may also be limited when the loss comes from user compromise. Good risk management means paying attention to both layers at the same time. Liquidity problems and insolvency can look similar from the customer side because both can block withdrawals. But financially, they mean different things. A liquidity crisis means the assets may exist, yet they are not readily available to meet withdrawal requests right away. Insolvency is more serious because it means liabilities exceed assets, creating an actual shortfall. From the user's perspective, both may produce the same immediate symptom: you cannot get your funds out. But the long-term implications are very different. A solvent platform can still fail to provide quick access, while an insolvent one may never make customers whole. That is why paper claims of solvency do not guarantee usable access in real time. Regulation, audits, and insurance can be helpful, but they should not be misunderstood as complete protection. Insurance policies may cover only narrow categories of loss, and they often have caps, exclusions, or conditions that leave many users uncovered. Audits and attestations can provide useful information, but they are usually snapshots rather than guarantees about future behavior or hidden risks. Licenses and regulatory registrations may indicate a degree of oversight, but they do not guarantee honest management or flawless operations. Compliance actions can even result in freezes that restrict user access. So these protections may reduce certain risks, but they do not remove the core dependence on the exchange's solvency, governance, and operational integrity. Investors should treat them as partial safeguards, not as a substitute for careful custody decisions. Imagine Maria keeps 10 ETH on an exchange because she wants convenient access. Then the exchange suffers a hot wallet hack and responds by pausing withdrawals while it investigates. Maria's account still shows 10 ETH, so at first glance it may look as though nothing has changed. But in practical terms, everything has changed, because she can no longer move the funds, transfer them to self-custody, or react to market conditions. If the price falls during the freeze, she bears that market harm without having control over her assets. And if the problem turns out to involve deeper insolvency rather than a temporary pause, recovery could become delayed, partial, or uncertain. The example shows why displayed balance and usable access are not the same thing. Many exchange losses begin with false assumptions rather than dramatic warning signs. Some users hear the word insured and assume they are fully protected, even though the actual coverage may be narrow or conditional. Others treat exchange balances as if they were the same as self-custodied assets, overlooking the fact that the platform controls withdrawals and key management. Leaving large idle balances on an exchange for convenience can quietly expand exposure over time. There is also a tendency to focus only on hacks while ignoring freezes, liquidity problems, poor governance, or legal disruptions. A more careful mindset asks a simple question: if normal operations stop, what exactly protects me? That question often leads to much better custody decisions. A practical way to evaluate an exchange is to look past its marketing claims and test how meaningful those claims really are. Start by listing the protections the platform emphasizes, such as cold storage percentages, insurance, attestations, licenses, or withdrawal controls. Then ask which of those actually reduces a specific risk in a meaningful way. After that, identify one protection that sounds reassuring but may have limited real coverage, such as insurance with exclusions or attestations that do not address liabilities fully. Finally, imagine a scenario where several problems happen together, like a breach, frozen withdrawals, weak controls, and financial distress. If those events overlap, would the protection still matter enough to preserve access? The goal is not to find a perfect exchange, but to understand the limits of the protections being advertised. Section 5. Scam Prevention. Scam prevention matters because crypto transactions are often hard or impossible to reverse once they are completed. In traditional finance, there may be chargebacks, fraud departments, or account recovery systems that offer at least some chance of repair. In crypto, a rushed mistake can become permanent very quickly. Scammers understand this and often focus less on breaking the technology than on manipulating people into acting too fast. That is why one of the strongest defensive habits is simply to pause before clicking, connecting, approving, or sending. Slowing down creates room for judgment. In crypto security, prevention is usually far more realistic than recovery. Most scams rely on a small set of emotional triggers rather than endless creativity. Urgency pressures you to act before thinking, often with messages suggesting your account is at risk or that a short window is closing. Impersonation borrows trust by pretending to be support staff, project teams, or even friends and colleagues. Greed appears through free token offers, guaranteed returns, or special opportunities that seem too good to miss. Confusion is also powerful because attackers may bury you in technical language or complicated steps so that you stop evaluating what is really happening. If you can pause and name the tactic being used, the message often becomes much easier to judge. Recognizing the emotional pattern is often the first step in resisting the scam itself. Although crypto scams come in different forms, they usually aim at the same targets: credentials, wallet access, or funds. Phishing scams use fake sites, emails, texts, or direct messages to capture logins or trick you into unsafe wallet interactions. Giveaway scams promise that if you send crypto first, you will receive more back, which is a classic trap. Ponzi and pyramid schemes pay early participants using money from newer participants rather than real underlying profits. Rug pulls happen when a project attracts funds and then the people behind it disappear or abuse their control. Impersonation scams pretend to be support agents, project teams, or trusted contacts to extract secrets or transfers. The packaging varies, but the goal is usually the same: get you to hand over control voluntarily. Scams often follow a predictable sequence, which makes them easier to interrupt once you know the pattern. First comes a trigger, such as a message, ad, social post, or direct link. Then the attacker adds pressure, creating urgency, fear, excitement, or confusion to reduce careful thinking. After that, you are pushed into a fake or unsafe interaction, like a spoofed website, malicious wallet prompt, or fraudulent support channel. The attacker then tries to obtain something valuable: a password, a seed phrase, a wallet approval, or a direct transfer. If that step succeeds, recovery is often difficult or impossible. The practical lesson is that you do not need to analyze the entire scam perfectly. Stopping at any point in the sequence can prevent the loss. A useful verification process begins with identifying exactly what is being asked of you. Are you being asked to send funds, connect a wallet, approve a contract, download software, share login details, or reveal a recovery phrase? Some requests should be rejected immediately, especially any request for a seed phrase or a private key. After that, verify the source independently through official channels, not through links or contact details provided in a suspicious message. If the message promises unusually high or guaranteed returns, treat that as a serious warning sign rather than a benefit. It also helps to search for credible complaints, warnings, or repeated reports from other users. A few minutes of verification can prevent mistakes that are far more expensive to undo. Wallet approvals deserve the same caution as direct transfers because they can create future risk even when no funds move right away. Some malicious or poorly designed apps ask for permissions that allow them to spend tokens from your wallet later. An unlimited approval is especially important to notice because it can grant broad access well beyond the immediate action you think you are taking. This is why a harmless-looking test interaction is not enough proof that the app is safe. The danger may come later, after the approval is already in place. Reading wallet prompts carefully, limiting permissions where possible, and interacting only with known applications are all essential habits. In crypto, Access can be stolen through approval just as easily as through a transfer. Consider a fake support alert. You receive a direct message claiming there was unusual login activity on your Exchange account and urging you to secure it immediately. The linked website may look almost identical to the real Exchange with the same logo, colors, and layout, but the URL contains a subtle change. Perhaps one extra letter or a character that resembles the real one. If you enter your login details there, you are not securing your account at all. You are handing credentials to the attacker. The safe response is to ignore the link and open the official app or a saved bookmark yourself. A convincing design means very little if the destination is wrong. When a message feels urgent or unusual, the safest response is calm and methodical. Do not click links inside the message and do not reply with account details, verification codes, or wallet information. Instead, open the official app or website yourself using a saved bookmark or a manually entered address you trust. If the issue is real, it should still be visible there. If the message turns out to be fraudulent, report it, block the sender, or mark it as spam so it is less likely to catch you again. The key habit is to break the attacker's chosen path. You want to verify through your channel, not through theirs. Many losses come from small oversights that seem harmless in the moment. A tiny domain change can be missed when someone is in a hurry. A direct message from supposed support may feel credible if it arrives right after a real login attempt or market event. Sharing a seed phrase or private key even once is enough to lose control permanently. Connecting a wallet to an unknown app without reviewing the permissions can create exposure that does not show up until later. Even verify badges can be misleading because they may reflect platform status rather than genuine trustworthiness. Scam prevention is often about respecting small details before they become large consequences. A personal checklist can make good judgment more consistent, especially when emotions are involved. Ask yourself what you are actually being asked to do. Send funds, log in, connect a wallet, approve access, or share information. Confirm that you open the official channel yourself rather than following a link from a message. Look for classic pressure signals such as urgency, secrecy, or promises of guaranteed profit. Notice whether the request involves sensitive actions like revealing credentials, granting wallet permissions, or sending assets. If anything still feels uncertain, stop and verify before acting. A short checklist may feel simple, but simple routines are often what prevent expensive mistakes.